All right, we're moving on to item 6, our private equity program. We've got John Haggerty and Steve Hart from Makita, our new private equity consultants. I don't know how long I can say new. You are our private equity consultants. Welcome, John and Steve. As always, we direct our folks to kind of be short on presentation, long on time for questions and interaction. So we will continue in that vein. So, Steve.
Well, thank you very much again this afternoon. I wanted to take a little bit of time and talk about our next phase of the review of the private equity program, kind of talking about how we got where we are today. You recall in our last presentation, we essentially compared the cash flows that were invested in the private equity program, and instead of they've been invested in public equities, what's kind of the difference there.
Could you get your mic on there? Yeah, just a there.
Oh, there we go. And comparing those cash flows to what they would be like if they were invested in the public equity program. And you recall there that calculated that the private equity program has created $13.5 billion of additional value. In this presentation, we're going to talk about how the private equity program has performed against a peer index, the State Street Private Equity Index, and comparing how that performance has been to date and seeing where that is. And then last, we're going to talk a little bit about the recent vintages in the program, kind of how they stack up against the public market index, essentially showing that in quickly rising public equity markets that private equity, not surprisingly, kind of lags that, and we really don't see a lot of difference in how that is performing compared to other vintages. So just quickly, in terms of the summary, the bottom line here is that the program has outperformed the State Street Index, total additional value about $2 billion. This is net of fees. I think that in terms of our analysis there, we didn't see a lot of surprises. We looked to kind of see which strategies drove that performance, what vintage years kind of drove that performance, to see if there's particular time periods or ways of investing that drove more of the value or less. And so what we saw there is kind of as we'd expected, the buyouts, the venture capital, the distressed equity, and mezzanine all added. We're just calling those the primary investment strategies, all added to value at the end of the day, while the clean tech and the proactive programs detracted from value. And as I just mentioned, the recent vintages look like they're performing reasonably similarly to other vintages that were invested during rapidly rising public equity markets.
Okay, so a few caveats to the analysis. First, this is a benchmark that you can invest in, and there's a couple implications of that. I would also mention that your private equity program is not driven from the top down, but rather from the bottom up. So as we look at the results here, you need to bear in mind that decisions are not actively made by your staff to emphasize one vintage year or one sector as a means of adding value. And then lastly, this analysis is not looking to evaluate specific decisions that are made by your organization, but really looking to answer the question, what helped you or what hurt you with respect to how you had capital allocated by vintage year, by the type of strategy, and the residual is what we call the manager effect, the selection of managers. It's simply that, so it's answering that question alone. And here are the results. It's fairly straightforward the way we put it here. You can dig very deep into these numbers, though. The total effect is a positive roughly $2 billion in added value over the State Street Index. The vintage year effect is positive $1.6 billion. The strategy effect is also positive $2.2 billion roughly. and the manager effect is negative 1.8 million. And we deconstruct that a little bit in further slides. A large portion of that has to do with the directed portfolios, and about 30%, 40% roughly comes from the mega buyout space, and another 30% roughly from the early stage venture space.
Harry, jump in.
Mr. Haggard, you mentioned that there were two drags on the portfolio. Was the proactive? What was proactive?
Proactive and clean tech.
And the clean tech.
On the slide.
Now, did you run anything in this report that if you had pulled those out of the pool, what the outperformance would have been?
Yes, we did that in an informal way, and we have the results for the last 10 years. And I can give you those numbers if you like.
At some point, it's not critical. I mean, the answer is you have that if we need it.
Yes.
And those two scenarios, those two approaches, the proactive and the clean tech, what was the drag? Was it manager selection? Was it the vintage year? What was the contributing factor? Or was it a combination of the two?
So the way that we evaluated that particular question was to essentially put it all in what we call the manager effect, to say that the choice was to otherwise take that capital and allocate it to an average private equity fund in that particular vintage year. So that, not saying that we would have gone into buyouts or venture or anything like that. So it would have just been invested into an average private equity fund.
Is that another way of saying that it was the category?
The what?
It's the category?
State Street doesn't have a category for
Okay.
clean tech or proactive to benchmark it against. Mm-hmm. So we didn't really have a strategy to do it against, and so that's why we just did it and called it a manager effect.
Chris, you want to chime in? Go ahead.
If you guys go back to that one slide, I want to highlight to the board, because clean tech surprised me as well. I knew it was tough because we were very early. There's a lot of 03, 04, 05 investments in solar, things like Solyndra. But I want to harken back to what Tom Steyer said to you, if you remember, where he said that early movers in clean tech is a really hard space to figure out who is right. And that he thought most of the money in clean tech might be made in more kind of boring efficiency types of things. And our 13-year history really bears that out. Even some of our most current investments that I was incredibly optimistic about, sadly, are hanging on by a string. So we hear all this good news about alternative energy and how great that is, and subsidies and how wonderful. But being an early mover has actually been kind of painful. I always quote the late Joe Deere, who said it's been an elegant way to lose money, but we've lost money. Doesn't mean the next generation or you don't want to be, you want to be in Facebook, you don't want to be in MySpace, so it doesn't mean that the latecomer into that field may not make money, but it just so you kind of keep that in the back of your mind, it's just really proven to be challenging. It's probably the way of the future, but it's been challenging at the start for us.
So the,
Go ahead.
So, I mean, this is a good report, and it confirms what I've always suspected, that this is a very successful program. And indeed, it's probably one of the most successful institutional private equity programs in the country, and Margot and Chris and the team should be congratulated on it. The question I've got is, can you draw conclusions to the extent, to the effect that we've outperformed, and whether that has implications for more aggressive commitments to the asset class? My instinct tells me we have outperformed, or not.
Well, I think that what we're saying is from two dimensions that from the alternative of investing in public equity markets, you have outperformed. From comparison to the State Street Index, you've also outperformed.
Right.
So that's kind of the two areas, and I think we wanted to kind of see what have been some of those drivers or detractors from that, and that's part of what the analysis is today.
Right. Okay. And then, the one thing you can't do is then, because this covers a very long period of time, is try and say, what are the implications of, say, the last 5 years? And it covers a lot of change in structure of portfolio, structure of managers, and all that. What are the implications of the portfolio we've constructed over the last 5 years over the next 5, and does it justify our commitment to, because this is our big commitment for alpha in the portfolio, and should we be confident about that?
From
Will
this
it continue to
this
be our
particular structure of analysis, the eggs haven't ripened in chickens yet.
Yeah.
So we can't tell, based upon the way this analysis is put together, any meaningful information in the last 5 years or so.
Well, yeah. Well, I understand as to the
Yeah.
particular portfolio. I was talking more about structure of the asset class, and is it likely? Do you find it likely that it'll be a source of alpha going forward? Alpha relative to public equities.
Mm-hmm.
I think we'd have to pay them more if they knew the answer.
Oh,
This is a topic that we're looking to turn our attention to in the next meeting. We happen to have a slide in this short presentation about really trying to think about the future of private equity. And this was in direct response to our last presentation where you wanted to examine the succession issue within the private equity industry. You wanted to examine, is it becoming more competitive? One element of that we examined with the performance analysis that Steve alluded to, where we took effectively your cash flows and invested them in, or looked at them compared to other periods where the stock market did well, to really confirm that you're performing, you're lagging today really in the same way that you would have lagged under past periods. And I think that's really important to know. So it partially answers the question, is the private equity outperformance of stock game over? And we would say, no, not based on our analysis of past periods of lagging, but then you have to dig in deeper and look at how competitive the marketplace is becoming. And that's a very long discussion. We don't have data to back it up, but we do have a lot of anecdotal evidence to give you that points to a much more competitive marketplace and a reasonable expectation for compressed premium return over stocks going forward. That said, we feel that the premium will be sufficient enough to continue to want to pursue the asset class. And I think you're structured more or less with your portfolio weights in a similar way you have been in the past.
okay. I'll wait till we see your next report.
Yeah, one thing I wanted to add on this chart, and Tom's first question about, okay, we have 13% allocated to private equity. It's beaten public markets. Let's put more in. We capped the asset allocation model at 13%. And part of the reason is what I call the hierarchy of size. At 18 to 20 billion, we're one of the larger private equity portfolios in the world. And Margot and team and I feel the tension. We have to put more money in buyouts because there's more size available there. If you look at this chart and you had only the ability to invest, say you were an endowment, you only had $3 billion you wanted to put to work in private equity, it could be half of your endowment and you'd be much more nimble. I always say, think of a speedboat spinning on a dime and we're the big cruise ship. So as they mentioned at the beginning, we're forced because of our hierarchy of size to over-allocate to buyouts, whether we kind of are confident that that will be better than venture or not. We just can't get enough access in venture that we do in buyout space. So, and Tom, PCA, and we have debated year after year We know we would like more private equity, but if we go even more in private equity, we're even more exposed simply not just to buyout, but to the mega buyouts. And do we believe that sector is going to beat the public markets or not? So it fits in. Your question is right, spot on to the asset allocation and that debate of how much can you put in private equity and can you still generate the returns?
Could I just,
Okay, sure.
the one other thing I think we have to watch over the coming years as we try and move to our full allocation is whether our unique requirements are increasingly an impediment to getting the best allocations. Because if that's the case, then it constrains our ability to get to where we want to go.
The answer is unequivocally yes. I'll get into names in more detail in closed session. But I think the material impact, particularly to our venture portfolio, you guys noted that we were particularly low in venture for a number of years. We were actually, this program was high in venture in its early years, and it was a huge benefit. But some of the state laws that have come into effect in terms of transparency are clearly what has impacted our ability to stay in venture. And frankly, kicked us out of many of the funds along the way, and so we'll talk about that.
Harry?
I think I'll wait until Mr. Hart and Mr. Haggerty finish their presentation,
Okay.
and then have,
Um,
when they're finished.
Paul, did you want to?
Well, I'm happy to wait. Let me just comment on one thing on Tom said, though. I mean, I would hope we beat the public markets because we're taking on more risk.
I
So
was talking about beating the
okay,
institutional performance.
okay.
And the State Street Index is a pretty good
Right.
measure.
So I mean,
There are others.
right.
So.
Okay. Good. With that, I'll wait till the end.
Okay. So just, you guys just chime back in when you're.
The specific differences in structure of the portfolio that you have versus State Street are here. And I can summarize that by saying you have 11 percentage points less in venture capital. And the balance of the differences is net in the category of equity expansion, clean tech, proactive, co-investments, and secondaries.
Right. So that's we'll get to some discussion kind of later about matching the index to what the program is, and that there's some different weights, and there's also different parts of the program that aren't specifically tracked into the State Street Index. Yeah.
So I just had a question on this chart as to what is equity expansion? What are we picking up there?
So equity expansion is a category, a CalSTRS category, and I think it's also known as growth equity. So it tends to be kind of more.
That answers it.
So what we had to do as part of our analysis here, frankly, was to push those investments into the State Street sectors of buyouts and venture.
Right.
So what we have here is it's a little different than what would be if you count. So these next couple of pages, again, just going back to the things we mentioned a few times about how the private equity program performs during rapidly rising private equity, public equity markets on the equivalent basis of to public equities. And I think the bottom line is that from our analysis, it looks like the CalSTRS program in the more recent years is performing similarly to how the program had performed during rapidly rising public equity prices. That was the other time periods.
Okay, so we just have two more exhibits, and they deal with changes in the industry and potential changes or revisions to policy that we could contemplate. And with respect to the industry, how will it unfold in the next 5-10 years? Competition is something we want to report back to you on. what we see and what it may portend for investment returns. Regulation is another. Structure of investments, that's a catch-all for co-investment formats and separately managed accounts, and the effect that might have on groups that need to deploy capital at scale. The integration in the global economy is something that may not be specifically related to policy or return, but we'll come back with more on that. We tend to think it is a positive effect that the private equity has in general on markets. International is something I think that should take quite a bit of time to talk about. You have exposure to the developed markets. You have a relatively small exposure to the non-developed markets, and interesting things are happening with respect to purchasing power of billions of people, and that portends strong growth in certain markets that can be captured pretty unique ways by private equity. We want to talk about that. I mentioned earlier succession planning. The industry is arguably a couple decades old, and in some firms are still managed by the people that founded the industry. And so what will it mean when the arguably more aggressive entrepreneurial founders of private equity firms turn the reins over to the next generation? Does that mean a diminishment in returns? And is this being handled properly, and how does it affect individual names within your own portfolio? One final comment I'll make and turn it over to Steve to wrap up. With respect to private equity viewing itself as producing 20% returns and 2 to 3x in any given market, you may still see that philosophy pretty consistently in the middle market, but increasingly you're seeing mega market managers express their own mandate or their objective as providing a premium return over the S&P 500. And I think that's a very interesting thing to observe. I can count 4 or 5 such groups that have explicitly put this in their marketing materials, and it makes clear that that's the value add that they will provide, and they seek to exist at a discreetly lower point on the risk-reward spectrum, but one that still may make sense for investment programs. So we want to talk about that as well.
So we talk about for next presentation, we alluded to some of the differences in terms of how the weights are in the private equity program compared to the State Street benchmark. And we wanted to talk a little bit about the investment policy and processes that are in place here at CalSTRS, talking about ways to ensure that it's in well positioned for being able to produce strong returns going forward. So things like pacing study, talking about investment sourcing, the alternative structures that John was mentioning, the fee transparency issues, and investment reporting. So do that for next time.
Harry?
Thanks for the report. I must say I'm relieved but not surprised by its findings. If you take the $2 billion in outperformance compared to the index, and you divided that by the average teacher pension, this asset class is paying tens of thousands of teacher pensions on an annual basis. So having said that, we know that the future is not going to look anything like the past. So I commend Margot and the team and our advisors and the managers, the partners that we've had that have helped to generate these returns. And I would caution us, as it's an industry that's ripe for change and reform. There's probably some low-hanging fruit that needs to be picked and addressed, and we probably should need, and we've discussed this need and should do that with some of our partners. But I caution us as we feel external pressures to paint the industry with a broad brush, because to the extent that we overreact to some of the pressures, and some of them are right, and some of the errors in the industry are egregious and should not be tolerated, and we do not tolerate them. But I think we need to proceed with exceeding caution and with our eyes wide open so as to not impede the opportunities that we're going to have potentially in a very competitive space on a going forward basis. And I would look to you as our advisors to help guide us in some of these decisions. And I think you did an excellent job, one, of telling us our story, essentially how has this asset class worked for this institutional investor since inception, net of fees, what has the outcome been? And I think you've done a nice job in setting the stage for us on a going forward and looking forward basis. And from my perspective, I think these are policy issues in which we as a board have some, we can pull levers a little bit. We're really not going to impact the, capital markets, public markets, and what we're going to do there. They're going to do what they're going to do, as we've said. But this is a space in which 10% of the portfolio, almost $20 billion, is allocated. And how we want that to be allocated going forward, I think we're going to need your help and support. So I just want to thank you for your presentation, the report, and get on record some of my thoughts and sentiments around this issue.
Thank you.
So this is very, very interesting, and I mean between the public market equivalent study and now this, I mean I think as several of us have already stated, I will state it again. It's very good to see how much of a contribution the private equity program has been, and with all the cautions about what might be in the future, that if in fact the mega managers are saying all we're going to do is give you a little bit of benefit over S&P 500, I think that may change our attitude and the way we invest. But that's for the future. So what the question I have, and well, some people may not like that I'm asking this question, but this is looking at INV 49, so it's not, I think, in your presentation. But if I read what is on INV 49, and I read what is said about buyouts and venture capital, which is really where the bulk of our, if you take out buyouts and venture capital.
Is this I think it's the same one, Paul. Is that
okay, that's it, yes. If you take out, if you look at everything other than buyouts and venture capital, the program was about a wash for us relative to the index, right? So let's look at buyouts and venture capital, which between the two of them provided, by your calculations, about $2 billion of return in excess of the index. But in both cases, the strategy effect and the vintage year effect were positive relative to the index. But in both cases, the manager effect was negative. And yet we always hear that what's important to our success is our ability to select managers and our access to those managers. So this seems to tell a different story. If it tells a different story, I'd like to understand it. If it doesn't tell a different story, I'd like to understand why it appears to tell a different story.
So there's a couple of aspects here to think about. One is that in the case of the venture capital asset class, the negative manager effect there is largely driven by a couple of managers, a couple of funds, actually. So that's one aspect in terms of thinking about that. The other is in the buyouts area, and Margot should address this in more detail, but what we only have here is the performance characteristics. We don't have the risk profile, and we don't know what the risk profile that Margot and the team were looking at and the set of opportunities that she was looking at the time that may have drawn her to certain choices. We don't have, this isn't a risk-adjusted kind of performance either. So there may be some things that she was looking at or they were looking at to try to mitigate some risk profile there.
I would just like to point out on the venture, and this is over the life of the program, and those two venture funds go back to the mid-90s, and the benchmark return for those years was incredibly high. It was in excess of 10x. In other words, the people made 10 times their money on the fund, and we invested in a couple funds that only returned 2x. And so that's resulted by this analytical method in a huge manager shortfall. So it is kind of an idiosyncrasy of the analysis, which I think is great and very worth doing, but that year got exaggerated. I would also point out that on venture, the top 15 funds or 20 funds in the world, we don't have access to. They don't tend to do public pension plans. So when those do quite well and they can have such a distorting effect on the benchmark, it's impossible for us to match that performance. One other thing about those couple funds, just for the record, back in the mid-90s when that we're talking about, those were in fact identified as venture capital in the analysis, and we had this discussion, but those were board mandate funds, again, with special mandate characteristics. We were sole LPs, and they were not. So there should probably be an asterisk near the venture capital one up there. In buyouts, the picture is a little more a lot of circumstances, but the venture, it's kind of an anomaly in this study, if you would agree.
Yes.
So, I mean, I saw elsewhere in here that basically 5 funds contributed in these 2 areas, contributed to, had they performed at the benchmark, our net benefit would have been more like $3 billion than $2 billion. So it's obvious that you know, a small, the universe isn't that big. So a couple of either, you know, mistakes or home runs can kind of perhaps skew things. Is that right? So that it's a little difficult to draw. I'm trying to figure out. In other words, if there's always a story to each one of these, what conclusions do we draw from this attribution analysis?
So I think that just on the venture side, just taking back part of the question, that as Margot was mentioning, the asset class has developed some over time that I don't think that we certainly can hope, but don't expect that there's ever going to be a vintage year where the average fund gets over 10x return. And that becomes a very difficult benchmark to meet if you don't participate in that way. So I think that there's going to be, the competition is compressing the returns that way. So there may be issues there that are going to mitigate that sort of set of future results.
There won't be so much dispersion going forward. It's hard to conceive of that. But I think another way to put it is that, at least for the venture capital delta, you want to think about idiosyncratic things and examine individual funds. It's not something that is related to specific policies or biases of the organization or staff, in my opinion.
Well, what about buyouts? I mean, what?
You just asked it. I was going to ask,
Yeah.
Can you explain to us buyouts? Why negative manager selection there? What could we think about doing better? Or what's the story behind the numbers?
Well, I'll first say it's hard for us to know with any certainty. We do not have visibility into the components of the index.
We just can kind of
We know what you're in, but we don't know what it's
Right.
matched up
So we don't know
against.
which particular manager. So we can look and we can see in which particular vintage years and areas where the program differed from what the benchmark was. So, and just looking at the vintage years, a good portion of that is the 2006 to 2008 timeframe. So with that, one can start to think about, well, what were the thought processes around the manager selection during that time period?
So I'm just trying to understand what we take away from this. I mean, because, you know, it does kind of, to me, it jumps out that you know, strategy effect and vintage year effect strategy effect in particular has been enormously beneficial to us, and manager effect has not, based on at least this slide. So
I can share what I take away.
Yeah,
from it.
okay.
When I look, and if you go back to the slide that shows the comparison between us and the benchmark, no, the one that one, there's quite a bit of difference. And remember, we don't know what the benchmark is, and this wasn't our benchmark. So for most of the program life, you know, we didn't have this as a reference point. But what this shows is that there are significant differences. And so there are reasons to, because of our size, might make it hard for us to meet the benchmark. But I think
because we're too big or too small?
Because we're large.
Because we're
large and have
Okay.
other handicaps, if you will, in terms of access. But I think overall we've done it. And, you know, I think if you look at the manager selection issue, there's 4 factors. There's buyout, venture, clean tech, and the proactive. Well, the clean tech and proactive, there really isn't a benchmark for those. The venture really is a proactive type investment, and it goes back to those 2 funds. So, you know, I think what this says is, despite our size and issues, you know, we've outperformed the benchmark and pretty much made good manager selections, even if we're slightly below. If you look up there right now, you can see early stage. That has been a very hot area to be in. You know, the index is 10, we're at 5. So, you know, things like that can have a.
Well, I mean, we do this because not because we want to rehash history. We do this because we want to learn something about going forward, and I just think we need to clarify our understanding about this, because I've always understood that our size actually gives us access to good managers. So I'm not sure that is consistent with then saying that our size made it difficult for us to meet the benchmark. In particular, if the reason, and by the way, we exceeded the benchmark, so we did not meet the benchmark. But especially if the problem has to do with manager selection, and maybe there's a fundamental problem with this analysis that we don't know, you know, the managers that are in the benchmark and things like that. In which case, if this information is brought to us, we should understand the limitations of what it's telling us. But I'm just trying to say, you know, it's really good that we look at ourselves and try to understand what we can learn from that for going forward.
Yeah, so let me help Margaret.
Hang on. So I got Harry and then Tom. So Harry.
I appreciate Paul's, Mr. Rosensteel's questioning, because he's getting at some, I think, really valid line of questioning, and I cannot decipher, I can't connect what my belief is around manager selection and what I'm reading here, and the answer that we're receiving isn't helping me at this point. What I think might be helpful, and might be the data, what might be helpful is at a future closed session, or even today, we can get some analysis from our staff directly as to, in this space, who those managers have been that have outperformed, and why those are such important relationships to us, and they could be brought to us in closed session and explicitly stated to us based on evidence and experience who they are, because I can't figure out, I can't reconcile my belief with what that slide tells us, and I don't think we're getting that answer right now. Yeah,
go ahead,
maybe.
Tom.
Well, I can help her out a little bit. So, one, the benchmark includes some, probably, they're more smaller and mid-sized managers than mega managers when you look at private equity. And there'll be periods where the smaller and particularly the middle market has outperformed. Over this period, the middle market has outperformed the mega in private equity pretty significantly. More significantly, on the venture space, the best managers, and actually our firm made this decision, we wouldn't take pension fund money because of the Freedom of Information Act requirements. And so other than for one very special mandate fund that we did, or the environmental funds where we partnered with people and seeded them, we wouldn't do it. Our other LPs objected to it. But Kleiner Perkins, Sequoia, the names you really know, Founders Fund, they just won't take pension fund money. So when you look at the benchmark, you're at a big disadvantage.
All right. Any other questions on that? Thanks, Margaret.
Just say for access, the access is our size is an advantage and a disadvantage. For the bigger funds, it gives us access to the advisory boards and fee discounts and such. But when we go to the smaller funds, our size is a disadvantage because the amount of capital we have to put to work makes it impractical for us to overweight or even match the weight of the index. So that's the contradiction there, I think.
So, Paul, I think we probably really haven't answered your question about why the buyouts, right? Why there's been a difference there. And so we have on INV 50 a breakdown of the buyouts by the sector. And you can see in there that a significant percentage of the manager selection differences in the mega buyout area. So it sounds like what you're asking for is further analysis as to kind of what has driven those selections of the mega buyout during that particular time frame.
Well, I think what I'm asking is there something that
Right, right.
Because we are still, heavily reliant on private equity. We just went
Through a asset allocation process where, we went to the maximum in terms of what we thought was reasonable. So, it's a change. It's a changing world. We're going to be talking about that, but this is, we do this partly to see what we can learn, and it may be that there's discussions that we should be having about individual managers that make up the impact, and that should happen. Not in public session, but that's my, look, we need, we're relying heavily on doing well in private equity, right? So let's learn what we can so that we can do the best job.
So I think this analysis really just tries to identify where are the areas, what are the vintages, and what are the areas where it's been, and then it doesn't answer the questions as to why. It just is aware. So come back and we can address that in more detail.
Tom?
Yeah, the one question that I'm still left with, because I'm very comfortable with the quality of management of our program, is whether we should think of traditional private equity, buyouts, strategic investing, control-based investing as one category, and as a sub-asset class venture, which is a different one, and with very different dynamics and very different opportunity sets available to us in particular. And then the third is kind of other, distressed debt, things like that, where we're relatively small and where the results have not been as good. And I think that's something I'd like to hear the staff come back to us on.
John, did you want
I
to comment?
think that's underway in a sense. Another way of phrasing your request is to look at the opportunity set that is real and exists for this program, define that, and make that essentially the benchmark or the assumed structure of the portfolio going forward. For example, a lot of programs have a range of 0 to, say, 10% for venture capital, acknowledging
Right.
the difficulty of access and kind of the cyclicality of its appeal.
Yeah, and really, if we're talking about 13%, are we really talking about 11% being buyout? And if that's the case, that's fine. I just like to know how we reasonably assess the opportunity set these days to get with really high-quality managers.
Great. Duly noted. Great. Thanks, John and Steve. Thanks, Margot, for your thoughts. I need everyone to stick with me. I'm going to give you some instructions now because we have some time constraints. And so we're going to take our open session item 8. Wait, is that right? No, I'm sorry. Item 7. We're going to have June Kim and David Murphy come up and go through a first reading of our global equity policy as pro forma. We can choose to adopt it today or not. And then what we're going to do after this item 7 presentation and conversation is we're going to go into closed session. And so after this item, I'll invite members of the public to go on your way, enjoy your evening, and meet us back here tomorrow morning at 8:30 where we'll kind of restart our investment committee agenda. We'll see how much we get through closed session this afternoon after this particular item. But I just wanted
we were going to do that for those 2 committees in the morning, remember?
I'm sorry?
We were going to do investments after the 2 committees.
Sure.
Yeah.
Whatever we want to do. Just
So-
we're going to do it tomorrow.
Yeah, we've
sometime.
got comp at 8:30 and then governance at 9:30 and then this would start.
Sure, that's great. But just so you know, it's not going to happen today. So we've got one more item in open session, and then we'll adjourn into closed session. Thanks, Jack. Appreciate you helping. It takes a village. Okay, so June, David. Hi.
Hi,
Hi
thank you,
there.
Madam
Let's
Chair.
talk
I'm June-
global equity.
Yes, I'm June Kim, Director of Global Equity. I'm here with David Murphy, Portfolio Manager. PCA and Makita are here also. This is the first reading of the Global Equity Policy Revision. There are 4 changes being proposed. The first is to reflect the recent decision in the asset allocation study that the board did. So it's to adjust the global equity policy benchmark for global index weights for U.S. and non-U.S. We're in a period of transition right now. We're transitioning to those market index weights. So the language that you have before you reflects the transition period. Once we reach the target weights, we would come back with another revision that would set the U.S. and non-U.S. weights at the index weights. The second change is to modify the non-U.S. policy benchmark to the MSCI ACWI ex-U.S. IMI index, which includes small cap stocks. The third change is to remove the soft dollar policy for our external managers. And the last change is to add in the associate portfolio manager classification, the daily trading limits for that classification. So David and I are happy to take any questions you may have at this time.
Yeah, I'm happy. I'm very comfortable with it. I move we adopt it now.
Second.
It's been second and thirded. So,
Woohoo! Speed up rules.
I've got, so it's been moved and seconded.
Yeah, I just had a question. So this is only item 7, not item 8, right? But shouldn't we just do item 8 at the same time? Aren't they kind of conforming?
The soft dollar policy revision. Chris was going to present on that.
Oh, okay.
He's a different
All right.
presenter,
Okay.
So I just kind of cover it.
Okay. It seems like once we do 7, we've acknowledged that we have to do 8,
No,
right?
Since this is moved quickly, let's just go ahead and do that. I'll take that as a recommendation. We'll do that. So let's go ahead and vote on item 7. Let's focus on 7 right now. It's been moved and seconded to adopt our global equity policy. All those in favor say aye. Aye. Opposed? Abstentions? All right. Thank you. It's been approved. It's nice to see you for 2 minutes, David. And never see you anymore. So let's go ahead and move to 8 for Arena's encouragement. I like that. Chris Ailman, do you want to say anything? Arena, I like your style. Any questions from the committee members on the soft dollar policy
That was
revision?
pretty self-explanatory.
Okay, it's been moved. Was it seconded? Oh, it was seconded? Okay, all those in favor say aye.
Aye.
Opposed? Abstentions? Approved. Wow, okay. I
We're
love
just
that.
policy demons this
I
morning.
love that.
Or this afternoon.
Okay, let's see, it's 5 o'clock. So let's go ahead.
Maybe we're angels.
So we're gonna, so we'll end here with, we'll adjourn out of open session. So if my staff colleagues can look around the room, if there's anyone here that is not a CalSTRS staff person or consultant, we appreciate you coming.